Hello, and welcome to a short video discussion answering the question, what is an HSA? With illustrated help from my friend Ben. Today's healthcare landscape is overrun with abbreviations. PPO, CDHP, PPACA. How can anyone be expected to keep them straight? One of the more common ones being thrown about is HSA. So what is it? An HSA, or Health Savings Account, is exactly that, a health savings account, not a health plan. It is an account in which you may save money on a pre-tax basis to cover your out-of-pocket healthcare expenses. So long as the money in the account is used for eligible expenses, it may be withdrawn tax-free. So that's pre-tax in and no tax out for eligible healthcare expenses. Sound familiar? That's right, it's similar to a flexible spending account. The biggest difference between an FSA and an HSA is that with an HSA, all the money you contribute and accumulate may be rolled over in the account year over year. You can also put more money into an HSA than you can into an FSA. So you could, in theory, grow your HSA into a nice sum of money over the years. For this reason, an HSA is often compared to an IRA, but for healthcare, not retirement. These comparisons are both valid and should give you a better idea of what an HSA is. So let's move on to the particulars. In order to be eligible to contribute to an HSA, a person must be participating in an HSA qualified health plan, or more specifically, a high deductible health plan. Once you've established an account, you choose how much you want to contribute, how often, or whether you want to contribute at all. The only contribution restriction in place with HSAs is the maximum amount you may contribute per year. This limit changes annually with inflation. This chart shows the current contribution limits imposed by the IRS. You should also know that persons age 55 and older are eligible to make an annual catch-up contribution in excess of the standard HSA limits. Your contributions to your HSA may be made at any interval you like. You could put in a lump sum at the beginning of each year, you could put in a certain amount each month, or you could even wait to fund the account only until after you've experienced medical claims. It's totally up to you. The IRS allows you to make HSA contributions for this year through April 15th of next year and still receive the same tax benefits. Another great feature of HSAs is that your employer could even make contributions to your account if they so choose. No matter how the money gets into the account, once it's there, it's all your money. Meaning, if and when you leave a particular employer, your HSA account and its total balance go with you. Now that we've covered contributions, let's go over distributions. As mentioned earlier, money in your HSA may be withdrawn tax-free to pay for eligible healthcare expenses. This could be doctor visits, hospital bills, prescription drugs, and even dental and vision expenses. The list of eligible expenses is managed by the IRS and can be found on the IRS website. Most HSA providers supply you with a debit card, which you may use to pay for eligible expenses, making it very user-friendly, so long as there is money in your account, of course. You may also file for reimbursement the old-fashioned way by submitting receipts for your eligible expenses. Either way, the money is distributed from your account tax-free. It's important to note, any money withdrawn from your HSA for purposes other than eligible healthcare expenses will be subject to ordinary income taxes upon withdrawal. If you are under the age of 65 at the time of such a withdrawal, an additional 20% penalty tax will apply. And that's it. That's the ins and outs of HSAs. There you go. Now you know. See ya.